Exercise 24-8 gives us an opportunity to deal with payback period and accounting rate of return with a constant, steady stream of cash flows, a regular stream of cash flows. So they tell us that each year, and it's right in the problem, each year they're going to have the same amount of sales from, or the same revenue generated by this investment. So we'll bring our 225 over because ostensibly we're going to get paid for that. We're going to be paying for materials and labor, so that's really a wash. We get 225 in, but 120 goes back out. Depreciation is not cash, so we don't need to consider that. Selling and administrative, again, like labor, it comes in but it goes back out, so we'll subtract that. And taxes, that's going to go out. In the words of Ben Franklin, there's nothing more certain than death and taxes. So the net cash flows after adjusting for the depreciation is $66,750. And that's what they expect to generate every year from this investment. Every year, the same amount. It makes our computations of payback period a whole lot easier. So let's take our payback period and figure that out. We're paying $360,000 for this asset. They tell us that. They tell us that at the end it'll be worth zero. So our total investment is $360 plus zero, $360. So our average investment is that divided by 2, or $180. Now we want to find out our payback. Our payback period is going to be the $360,000 that we paid. Let me pull this down so you can see it too. The $360,000 that we paid divided by 66,750, 5.39 years. When you have an even amount of cash flows, where you have a steady stream of cash flows, it makes finding the payback period easier because you're not playing that silly how much did we pay in this year game. Now the average rate of the accounting rate of return, we take the 66, was it the after-tax income, the actual income that's reported, 36,750, not the cash flow income, the actual reported income, 36,750. And we're going to divide that by our average investment of 180. And our accounting rate of return is 20.42%. Now, the things that you can screw up with this is for the income you can grab the cash flows and not the net income. That's a common error. The next common error is to forget to add back depreciation to the cash flows, but leave it in when you're looking at income. So, 24/8 payback period and accounting rate of return when you have an even stream or a regular stream of cash flows.